Okay, so you want to own a fast food franchise. You've seen the numbers. You've seen the drive-through line wrapped around the building at lunch, cars idling 3 deep, cash register practically ringing itself. You picture yourself checking sales on your phone from somewhere that isn't the store, a district manager handling the headaches, a proven brand doing the marketing for you, a business in a box that just works. By the name, follow the manual. Watch the deposits hit your account. Here's the problem. Almost none of that is how this actually works. The brand you're buying into is not selling you a business. It's selling you a very specific, very narrow slice of a much bigger machine, and most of what makes that machine profitable was never designed to make you rich. It was designed to make someone else rich off of you. Let's start with the scale, because the scale is what sells the dream. The U.S. fast food and quick service industry does somewhere north of $370 billion a year. There are more than 200,000 quick service restaurant locations across the country. The big public franchisors post revenue in the billions, growth on every earnings call, stock charts that only seem to go up. And then you look at what an actual single-unit franchisee nets. After everything, and the number falls off a cliff. Industry-wide, store-level net margins for franchised fast food locations typically land somewhere between 3 and 9%. Not 30, not 15, 3 to 9. That's the whole story compressed into one contrast, and almost nobody selling you the dream leads with it. And fast food franchise isn't one business anyway. It's 3 or 4 completely different businesses wearing the same drive-through window. There's the mature mega brand, your McDonald's, your Chick-fil-A high 6 or 7-figure buy-in, brutal selectivity but real, provable, repeatable unit economics if you can get in. There's the mid-tier established chain, a Wendy's, a Taco Bell lower entry cost, decent brand recognition, thinner margin cushion. There's the emerging brand chasing rapid expansion, where the franchisor is more interested in collecting fees to fund its own growth than in whether your specific location survives. And there's the multi-unit operator tier, people running 5, 10, 30 locations, where the math completely changes because scale absorbs fixed costs that would sink a single owner. Same industry, 4 completely different risk profiles. So what does it actually cost to get in? Let's itemize it, because this is usually the moment the fantasy starts leaking air. The franchise fee alone, just the right to use the name, runs somewhere between $20,000 and $60,000, sometimes more for the marquee brands. Then the real money starts. Land and building, if you're not leasing from the franchisor directly, can run $600,000 to $1.8 million depending on market. Build out and equipment, kitchen hardware, fryers, POS systems, drive-through tech, signage, another $300,000 to $800,000. Initial inventory and opening supplies, tens of thousands more. Add required liquid capital reserves most franchisors demand you prove you have before they'll even sign, often $150,000 to $500,000 sitting untouched as a cushion. Total it up and you're looking at somewhere between $1 million and $2.5 million just to open the doors on a single location before you've sold a single fry. That's the moment the viewer's stomach is supposed to drop, and it should, because most people picture this as a $150,000 small business loan situation. It is not. Now here's the part that actually matters, where the money really comes from, because it's not where you think. Layer 1 is what you assumed was the whole business: food sales, burgers, tacos, fried chicken, whatever's on the menu. This is the obvious layer, the one on the marquee, and here's the twist. It's actually the thinnest margin layer in the entire structure. Food cost alone typically eats 28 to 34% of every sales dollar before a single employee is paid. Labor eats another 25 to 30%. You're already down to roughly 40 cents on the dollar before rent, before royalties, before anything else touches it. Layer 2 is the royalty and ad fund, and this is where most people's understanding of franchising stops. But it shouldn't. You pay the franchisor 4 to 6% of gross sales as an ongoing royalty, not profit, gross sales, whether you made money that month or not, plus another 2 to 5% into a national advertising fund, you have zero control over how it's spent. On a store doing $1.5 million a year, that's $90,000 to $165,000 a year leaving your account before you've covered a single operating cost, purely for the right to keep using the name. Layer 3 is the one nobody outside the industry talks about, and it's bigger than the royalty. Real estate. A huge number of major fast food franchisors don't just license you the brand. They lease you the land and building, then charge you rent. And that rent is frequently marked up well above what the franchisor itself is paying on the underlying lease or mortgage. Some contracts layer a percentage of sales rent on top of base rent. So as your store gets busier, your landlord, who is also your franchisor, takes an even bigger cut. This is not a side detail. For some of the largest chains in the country, real estate income exceeds royalty income as a total revenue source. Sit with that for a second. The company selling you the burger dream makes more money being your landlord than being your brand partner. And layer 4, quieter still, vendor rebates. Franchisors negotiate national supply deals with food distributors, equipment manufacturers, and packaging suppliers, and those deals often include rebates and kickbacks paid back to the franchisor based on system-wide purchase volume. Volume that you, the franchisee, are contractually required to generate by buying only from approved vendors at their negotiated prices. You don't see that rebate, you just see the invoice, which brings us to the insider trick. The mechanism almost nobody outside the industry has actually had explained to them plainly. It's called the sale-leaseback, and it's how a lot of these brands quietly became real estate companies wearing a restaurant costume. The franchisor buys or develops the land, builds the store, then sells the real estate to a separate investment entity, sometimes even one it partially controls, and immediately leases the building back long-term, often for 20 years, with built-in rent escalations every few years. That entity now collects rent forever, off an asset the operating company no longer even has to carry on its books. You, the franchisee, are the one actually paying that escalating rent every month, on a lease you likely didn't negotiate and can't easily exit. It's a completely legal, extremely common piece of financial engineering, and it's arguably the single biggest reason a hamburger company can trade like a real estate investment trust. Because in a lot of ways, it basically is one. Then there's the grind, the daily bleed that has nothing to do with any clever financial structure, and everything to do with just staying open. Labor, especially post-2021, has climbed hard in most markets, and a single location owner is often paying $18 to $24 an hour loaded cost per crew member depending on the state. Maintenance reserves for fryers, HVAC, walk-in coolers, and drive-through tech budget $15,000 to $40,000 a year, and that's before something actually breaks. Financing carry because almost nobody pays $1.5 million in cash. Interest on that SBA or conventional loan alone can run $8,000 to $15,000 a month depending on rates and terms. Utilities, POS software subscriptions, required tech upgrades the franchisor mandates on its own schedule, insurance that keeps climbing every renewal. Every single day the doors are open before you've sold anything, you already owe money. That's the real cost of the business, not the sticker price to get in, but the cost of simply existing inside it every single day, whether customers show up or not. And this is where the structural risk lies, the one domino that can take the whole thing down, and it's baked directly into the contracts, not just bad luck. Most franchise and lease agreements are cross-defaulted, meaning if you fall behind on the lease, you're often simultaneously in default on the franchise agreement, and vice versa. Miss enough payments and the franchisor can terminate your right to operate under the brand entirely, at which point you still owe the remaining lease, still owe the loan, but no longer have a business to generate revenue from any of it. Layer on top of that the fact that most franchise agreements cap or restrict your ability to raise menu prices independently to protect brand consistency across the system, which means when beef, chicken, or cooking oil prices spike, as they did hard in 2022, you frequently can't fully pass that cost to the customer. You just absorb it. You have almost no pricing power over your single largest input cost in a contract you sign voluntarily. If you want to see how this actually plays out, look at NPC International. At its peak, NPC was the largest Pizza Hut franchisee in the entire country and one of the largest Wendy's franchisees too, over 200 restaurants across nearly 30 states, a company that had operated for more than 50 years. In July 2020, NPC International filed for Chapter 11 bankruptcy. The story wasn't a single catastrophic event. It was the slow accumulation of exactly the pressures we just walked through. Heavy debt taken on to fund aggressive expansion. Thin, commoditized margins on a product facing intense price competition. Real estate and lease obligations that didn't flex when sales did. Rising labor and commodity costs the company had limited ability to pass through, compounded by pandemic-era disruption to dine-in traffic. NPC ended up closing several hundred underperforming Pizza Hut locations and eventually sold off large portions of its restaurant portfolio through the bankruptcy process. This wasn't a mom-and-pop franchisee who didn't understand the business. This was one of the most sophisticated, largest-scale operators in the entire system, and the underlying economics still buried it when the cushion ran out. So how do the people who actually win at this game do it differently? Scale, structurally, is almost the entire answer. Multi-unit operators running dozens of locations spread fixed corporate overhead, accounting, HR, regional management, across many stores instead of one, which is exactly the kind of math a single-unit owner can never make work. They negotiate better supply terms because their volume gives them leverage the franchisor actually respects. And here's the real one. The smartest operators don't lease from the franchisor at all if they can help it. They buy the underlying real estate themselves, sometimes forming a separate LLC to hold it, and lease it to their own operating company. Now the rent isn't leaking out to somebody else's balance sheet. It's building equity in an asset they control, an asset that appreciates independent of whether the burger business itself ever hits a great year. Some of these operators are barely even in it for the food margin anymore. They are in it for depreciation write-offs, for the real estate appreciation, for the eventual sale of a multi-unit portfolio to a larger group. The restaurant becomes the vehicle. The asset is the destination. Let's put real numbers next to a good year and a bad year, because the swing is the part people never see coming until they're living inside it. Good year. A single location does $6 million in sales. Food and labor run efficiently at combined 58%. Royalty and ad fund take 9%. Rent takes 8%. And after every operating line item you clear roughly $110,000 to $140,000 in owner profit before your own loan paydown. That's a real livable outcome. It's why people keep signing up. Bad year. The same store does $35 million because a competitor opened half a mile away and a local economic slowdown hit. Food costs spiked 2 points on a beef price shock. You're short-staffed, so you're paying overtime premiums to cover shifts. And after royalty, rent, and debt service, you clear $15,000 to $25,000 for the entire year, or you don't clear anything at all. Same store, same owner, same brand on the sign. A $250,000 swing in outcome driven by variables that were mostly outside your control the moment you signed the lease. So is it actually worth it? Here's the real answer, not the hedge. If you're going in as a single-unit owner with $5 million financed at a stretch, planning to run one location and live off the profit, the math is tight enough that a single bad year, a single competitor, a single supply shock can wipe out years of gains, and you're carrying almost all of the downside risk while the franchisor collects royalty regardless of your outcome. That's not a hypothetical. That's NPC International story playing out at a smaller scale. But if you're coming in with real capital, planning multi-unit from day one, buying the real estate underneath your stores instead of leasing it, and treating the food business as one leg of a broader asset strategy, this can genuinely build wealth, and it has, for a lot of people who did exactly that. The business rewards operators who understand it's structurally an asset-and-scale game. It quietly ruins people who thought they were just buying a proven recipe and a loyal customer base, because that was never really the product. The burger, the taco, the bucket of chicken, that was just the traffic generator. What you were actually being sold into was a real estate and royalty extraction system wearing a drive-through window as its face.